Well, good morning, everyone. It's 10 o'clock, so let's get the ball rolling. I'll call the meeting to order. Item number 2 on our agenda is to approve the minutes of the meeting of December 9th, 2021. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Yes. Okay. Item is approved. Item number 3 on our agenda is the consent docket. Item 3A, I want to congratulate Carla for being reelected to another 2-year term. Congratulations. Item number 3B is the annual consolidated financial report for the fiscal year ended June 30th, 2020 and 2021. And Amy Parker from the Accounting Services Division is here to give us a brief overview.
Good morning. Thank you, Mr. Chairman, Board of Trustees, and attendees. This is the kind of news I like to give. I like to make the presentations when we come through an audit season, and it's really good news. So I will be presenting the June 30 of 2021 financial statements. The trust was issued an unmodified opinion by our auditors, and if you would like to read that opinion in detail, it's located on page 11. But just to summarize the highlights, the good parts, because there wasn't any bad this time, I'd like to direct your attention to page 17 to the statement of fiduciary net position. I think one of the things we can all agree on is we kind of like to know where we stand net position wise, so I think it's important to point this one out. We increased our net position over the last year from $760.4 million to $944.1 million. And so that was a $184 million increase, which is something I don't know that we've ever even seen in this trust. So that was great news. I think we know that the majority of that was because of how well the returns on our investments did. I don't think that's sustainable, but we'll sure take it when we can get it. So if you'll turn to the next page, on page 18, to the statements of changes in fiduciary net position, you will notice that our contributions increased by about $2 million, as did our benefits paid out. So the contributions only increased by the amount of the benefits paid out. So that really didn't play into that $184 million increase. It was mostly due to, like you can see there, the net investment income went from $29.8 million to $208.4 million. And so we had an incredible year there. The last thing I would like to point your attention to is if you'll turn to page 40 with me. It seems like we're usually very interested in how well, it's actually page 41, how well funded our plan is. And our last year, if you'll remember, we changed our assumptions. And so because we changed those assumptions, what accounting-wise is referred to as they use very complicated words sometimes, as a plan fiduciary net position as a percentage of the total pension liability. But basically, that's how much is our fund planned in. And this year, we not only gained what we lost last year because of our change in assumptions, but we overdid that. So where we ended last year in 94% funded, this year we went back to a net asset, and so we are 111% funded if you look at in those terms. So basically, the trust has enough net position to pay what the actuaries give us as our total liability. Yep. So I think in brief, that's all I have to present. I take any questions at this time, if any of you have any questions for me.
Yeah, I'd just like to say I appreciate the accounting staff on their due diligence in getting this report done. And I went over this with the treasurer, or the controller, and Amy a couple of days ago, and we were really kind of like giddy over this because this is really good news, and it's a testament to the foundation that this board has has established many years ago and how we've held true to that and been disciplined. And I just can't say enough how much I appreciate everybody's work on this over the years. And we were blessed with great returns. And so, Jake, thank you. So, keep it up. She said it's not sustainable. I think it could. I'm just kidding. No.
If we can, let's go for it.
But we can try. But no, I just appreciate you and your leadership in the accounting division, and thank you for all your hard work on this.
Totally agree.
All right, thank you, guys.
Thank you.
Could I,
No. Marty?
yeah, could I, sorry, I should speak up a little bit louder.
That's okay.
No, I just had one question, and it's kind of in the details. I don't mean to, kind of pin you down on anything, but on page 15,
On 15,
yeah, it's on the
Okay.
summary of changes in fiduciary net position. There in that second line item down, investment income net, big change between 20 and 21, and I suspect that's probably something to do with the COVID events that were going on, but just because that's such a large swing in there, I wanted to raise that question to see if you knew what it was, and maybe there's, like I say, I don't mean to pin you down, there might
it's
not
the
be a good.
returns on the investments. The investments were the total, I mean, they increased that much this last fiscal year. Due to, he can probably answer those questions better than I can, why the returns were so good, but it is definitely, everything else was consistent, but those investment returns, they just were incredible. Like I said, I don't know that I've ever seen returns like that, so.
The comparison year over year, if you're using your fiscal year ending June, the year before, you had the big downturn in the first quarter of 2020. And so at the measurement point in June, the return wasn't as strong as from June of 2020 to June of 2021.
Yeah.
With that endpoint.
Pretty amazing how much that pandemic affected us worldwide. That's amazing swing in numbers there.
Yeah.
But I appreciate it, and yes, it's absolutely a glowing report. Thank you for that presentation.
Any other questions for Ms. Parker? Hearing none, Chair will entertain a motion on item number 3. I have a motion and a second on item 3. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item number 4 on our agenda is to ratify approvals. We can take those with one motion. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item number 5 is to approve the claims docket. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item number 6 is to approve the following applications for service retirement. We have several this month. I have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Get in there, it's a long agenda, it's a long Item number 7 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item passes. Item number 8, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote? Okay. Passed.
Item is approved. Item number 9, receive report of death, authorize the secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item number 10, approve request of the following to terminate vested rights and commence retirement benefits. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item number 11 is items for individual consideration. Item 11A is the renewal of the contract for medical examinations and evaluations of applicants for disability retirements with Independent Medical Examinations, LLC, retroactive to January 1st, 2022 through December 31st, 2023. Does anyone have any questions? Hearing none, Chair will entertain a motion. Motion and a second. Please record your vote.
Trustee Culver, how do you vote? Okay.
Item is approved. Item number 11B is the interest rate to be applied to employee contributions for the period of January 1st, 2021 through December 31st, 2021. Does anyone have any questions on that item in your packet? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item 11C is the cost of living adjustment to be granted to eligible retirees effective January 1st, 2022. Anyone have any questions? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote.
Trustee Culver, how do you vote?
Item is approved. Item 11D is to receive private equity and real estate program review and recommendations. Good morning, sir.
Good morning. With me this morning is Dan Pogue, Senior Research Analyst covering private equity and private markets, including real estate at ACG. We have a couple of recommendations to make this morning. One is a re-up to a private equity fund that you invested in 2020, come back a little bit sooner than expected, and that's reflective of how good the markets have been and how quickly these firms have been able to put money to work, and which we were going to do last month, but unfortunately wasn't able to be here last month. And then a second opportunistic real estate strategy, Angelo Gordon, that we'll be making a recommendation on. It's a new strategy. As you may recall, we've been underweight in real estate, particularly the opportunistic real estate, and we're going to need to add a few strategies there. This is a very compelling opportunity that we believe makes sense for your plan. But before that, Dan will walk through just some review of the portfolio and how we come to these decisions. I'm going to switch and let you speak.
Thank you, Jason. It's good to be with everybody this morning. So I know we got quite a bit of material to cover across the private equity and the real estate market update, the recommendations. We'll try to be relatively brief but thorough as we go through this, and please stop us with questions as we go. So starting on slide 5 of the private markets presentation that you'll have. So we'll start with a few slides on the private equity market environment, just to paint the context on what we're seeing from a market dynamic standpoint. We'll talk about your portfolio and then get into the Francisco Partners recommendation. On slide 5, this just shows through March 31st of last year the longer term net returns for different private equity strategies versus different public equity benchmarks. So large cap domestic with the S&P, small cap domestic with the Russell 2, and then global public equities with the ACWI. And you can see, particularly over 10, 15, 20-year timeframes, private equity strategies, whether it's buyout or venture, continue to perform quite well. On average, still generating at least 150, 200 basis points of net outperformance versus public equities. There can certainly be noise over year-to-date periods, one-year periods. Again, keep in mind that private equity is at least a 10 to 12-year duration investment. And so that's why we really like to focus on those longer-term timeframes. So absolute returns have been good, but importantly, relative returns have been good as well. On slide 6, this is a slightly different way to view performance. This is for all private equity, including buyout, venture capital, mezzanine type strategies. And instead of showing 5, 10, 15-year time period returns, this just shows for each vintage year. So for all of the funds, for instance, that were raised in 2010, those funds collectively have generated a median net annualized return of 13% through June of last year. And what you can see is that certainly during periods leading up to dislocations like the global financial crisis, I think 2004, 5, 6, those funds have underperformed what we would otherwise expect, but have still done a decent job of preserving capital. But certainly during up markets, which we've seen for public and private equity, returns have been very strong over the last 10 years. And I'd point you to the 2016 and 17 vintage year returns, about 22% each. A lot of that is driven by venture capital, especially early stage venture capital. Those strategies, after underperforming for most of the early to mid 2000s, have really come back very strongly over the last 10 years, especially over the last several years from a relative return standpoint. So we're always cautioning clients, yes, performance has been very good, but certainly we're not aiming or expecting for 22% net returns going forward. If we can capture the average that we've seen historically, which is in that 12 to 14% net range, we still think that that leaves the portfolio well positioned to generate an excess return versus public equity. And then lastly on the market, on slide 7, I think it's important. Certainly there's a lot of headlines discussed around the valuations within private equity. I think it's important to, one, acknowledge this. Yes, valuations are at all-time highs. Managers are paying about 12 times earnings on average for the companies that they're buying. But that's still a 30+% discount to the PE valuations that we're seeing for both large and small cap public equities. And so that's not to say that managers can drive excess returns simply by buying cheap in private markets and then selling it at a higher multiple in public markets. But as we think about some of the valuation pressure, there's still an ability for high-quality managers to find these high-quality private companies and ultimately capture some of that valuation arbitrage and use that as at least one lever in terms of how they can continue to create value going forward. Unless there's any questions on that, we'll move along to slide 8 now, which gets into your portfolio specifically for private equity. This just shows all of the existing managers in the portfolio across the strategy landscape. So venture capital on the left, higher risk, higher return, credit on the right, lower risk, lower return, and then buyout in the middle, which is really a sweet spot in terms of risk return across the private landscape. And for your portfolio, you can see we have good, balanced manager coverage across all of these verticals. Certainly what we want to do is always find managers that can balance risk return, have complementary strategies and exposures, but be cognizant about the all-in number of managers in the portfolio as well. And so if we flip ahead then to slide, let's go ahead to slide 10. This gets to the cash flow pacing for the portfolio, and this should hopefully look familiar to everyone. And ultimately, you can see that we have a 10% target to private equity this is through November. We were at about 7.2%, so about 3% underweight that 10% target to private equity. And certainly the portfolio has been making very consistent commitments over time. And we typically update this at least twice a year, and so really the goal is to efficiently achieve that 10% target, long-term, not meaningfully be overweight or underweight that. And so we always update this with real-time information for the total portfolio as well as for the private equity portfolio specifically. And as we're showing here, you can see about $35 million of annual commitments over the next 5 years we think will help us achieve that 10% target within about a 4-year time frame, and then ultimately maintain that 10% target longer term.
I will point out that even this slide is a little bit dated because we ran this analysis in November for the December meeting. So running it in November, we had October market value. So you'll see that number in green, $929 million. That was the total portfolio value at the end of October. At the end of the year, it was $960 million. So your actual allocation to private equity at the end of the year is a little bit lower at 6.8%. So, even using these numbers, it's conservative. But this is really a guide. The pacing commitment numbers of $35 million a year, we're revisiting that every time we're making commitments. We're not locking in another $200 million in commitments today. It's just a guide to tell us that's about what we need to do in any given 12 to 18-month period.
And in general, we would expect that $35 million to be split across about 2 to 4 commitments a year. Again, we want to add complementary strategies, complementary managers, but remain disciplined in terms of the total number of firms that we have to account for in the portfolio. And so on slide 11, this just speaks to the pipeline that we see throughout 2022. Again, keeping in mind that we'd expect to make 2 to 4 commitments, and that's 2 to 4 managers, really. What you'll see with Francisco, that's a good example. They're raising 2 similar strategies at one time, so that will actually be 2 funds with the same manager. We'd expect to have a similar situation in a couple of months with Firstmark. So you may wind up committing to 6 or 7 funds in a given year, but that will be across 2 to 4 managers in total. And so the recommendations for today, as we'll get into, are to an existing technology buyout focused manager, Francisco Partners. That was a commitment that was approved a couple of years ago by this group. And I'll touch on that a little more in a little bit in terms of the strategy and how we think they're positioned from a return standpoint. But again, you can see here really all of these managers are existing managers in the portfolio, primarily, again, focused on the foundation from a risk return standpoint, which is buyout. It's the most steady, it's the most consistent from a risk return standpoint, and then thoughtfully complementing with higher risk, higher returning strategies like early stage venture with a high quality name in the portfolio in the form of Firstmark. Any questions on the market, the portfolio, anything before we just quickly walk through the thesis behind Francisco Partners?
Lift, is that correct?
Yeah, that was the same question I had.
Yeah, and some of that too was we lump growth equity in with venture. And over time, ideally, what we'd like to see is about 70% in corporate finance, about 30% in venture growth opportunities. And so down the line, as we continue to think about, because you'll see in 2025, 2026, we're frankly, we're probably overweight corporate finance in that respect. And so about 4 to 5 years out, potentially looking to overweight, not necessarily venture, but more balanced growth equity type strategies to bring up that venture growth allocation as we think about
completely flip those two?
Yeah, and that wouldn't necessarily be a long-term thing, but we can thoughtfully do that with high-quality managers was the thesis there.
So going back to page 6, I believe, page 5, sorry.
Yeah.
Slide 5. So the 20-year returns, venture actually underperformed the S&P and the Russell, but yet you're still comfortable with allocating $25 million in 2026? Why? I mean,
Well, I would ignore the 2026. I mean, we're not locking into that. All we're trying to do with this pacing plan, roughly, the market is about 75% corporate finance, 25% venture. And as you'll see at the bottom of page 10, as we move along, if we're doing what this pacing plan is saying, you're going to get top-heavy in corporate finance. So we're just putting in that model, that flip-flop to say, okay, at some point, we're going to need to balance it out. We're not locking in anything other than today. We're saying mathematically, to get to our target of 10% in a reasonable period of time, we need to make commitments of approximately $35 million a year. And we're going to be thoughtful as to how we do that between corporate finance and venture, and at times, even distressed or turnaround strategies like Carval that we did in 2020, right after the pandemic started. We made some distressed allocations, and it may be that other opportunities come up or the market changes over time. But I wouldn't get too bogged down in those, the different commitment areas.
Thank you.
kind of along the same vein, given that venture capital is obviously higher risk than the S&P 500, but yet the 20-year mark showed underperformance compared to the S&P, why are you guys opting to continue to invest in venture capital versus just moving it into a different asset class that has lower standard deviation and higher return?
As we look at asset allocation work, which we will do it again probably next month, we looked at it last year and we actually increased your private equity from 5 to 10%. As a pension fund with long-term liabilities, that needs to, while you've been very thoughtful in bringing your return assumption down from an actuarial standpoint, still at 7%, it's going to be pretty challenging to get to a 7% return with long-only equities. Despite what you see in the rearview mirror, our expectations for large cap U.S. equity going forward, it's the capital market assumption for U.S. large cap is our lowest equity capital market assumption. Small cap and international, we have a premium, and then private equity a little bit more. So just looking in the rearview mirror, if we looked at that, valuations are very high in public markets. Private markets are more attractive. So from a return standpoint, we just view it as more attractive.
Yeah.
And that captures the tech bubble as well, right? And so again, I mean, for most of the early to mid 2000s, venture capital was one of the worst performing private equity strategies. It's been easily one of the best performing for the last, 7 of the last 10 vintage years. So, we don't certainly want to load up on venture now because another tech bubble could happen. I think the market has changed, the maturity and the health of the companies coming out of the venture ecosystem into the public markets has improved a lot since the tech bubble, and so we're not necessarily saying that will happen, but we won't continue to get 25+% returns from venture. So it's thoughtfully increasing that allocation so we don't give up the returns that we've seen out of that space over the last 10 years because there's been a lot of alpha. But again, doing it thoughtfully so we can stay balanced with that.
Okay. Thank you.
And so on slide 13 is where we start the recommendation for Francisco Partners. And again, there's 2 funds that we're here to discuss today. Fund 7 is their flagship fund on page 13. And then we have Agility Fund 3. And really, these are the same strategies, same team, just going after different size companies. So think of Fund 7 as writing equity checks into companies that are typically above $200 million, so $200 million investments from the fund. And Agility is everything below $200 million. But other than that, the strategies, the focus, the types of companies are the same. And Francisco is a group that we've known for a long time. They're solely focused on buyouts, specifically growth-oriented buyouts in the broader technology space. They'll do everything from software to consumer technology to healthcare technology. And the team that's been doing this has been very steady since about 2006, whenever the current team took over leadership of the firm, and that's really starting in Fund 2. And so if we flip to slide 15 and just look at the performance that the team and the strategy has been able to generate over the last 15 or so years, you can see that in an absolute sense, of consistently generating north of 20% net annualized returns on a cash-on-cash basis. So the TVPI, which is how much your investments are worth as a multiple of the amount of money you've paid in, consistently a very strong absolute returns there. But importantly, relative to peers, so if you look at that TVPI, IRR, and DPI quartile performance, so that's how they have performed on a quartile basis versus peers that raised in similar years. And you can see they're consistently first quartile, but almost always above median versus their peers. And importantly, that's not just because of unrealized gains. If you look at DPI, that's the amount of money that you've actually gotten back, so distributions as a multiple of what you've paid in. They're consistently above peers there as well. So they're not only finding high-quality companies, realizing value in those companies, but they're actually getting out of those companies, be it to other financial sponsors or via public markets, and posting very strong realized returns. And again, they've done that very consistently over the last 15 or so years, and they've also outperformed public markets during that time. So again, a group we know very well, a high-quality existing manager. In your portfolio, the only other thing I would say before getting to the specific dollar recommendation, Jason alluded to this. So you all committed to Agility 2 and Fund 6 really just a couple of years ago, and so they are back relatively quickly. And if you think about the strength overall that the technology market has experienced, some of it is due to that, but a lot of it too is due to taxes. So deals that they would have done in 2020 got pushed to 2021, that was the COVID effect, and then a lot of deals that may have gotten pushed to 2022 got pulled forward to 2021 because people were afraid that tax rates were going to go up. And so that really consolidated a lot of deal volume within a pretty condensed 9 to 12 month period. And so we don't suspect that they will actually call capital or activate this fund until later in this year. They still have deals to do in the current funds, but they wanted to make sure that they had capital ready to go in case that deal pace continued, because obviously these managers never want to be out of the market. They always want to be able to source high-quality deals and act on them. And so we think the actual time in between funds will be more like 3 years, but they are back now opportunistically to make sure they have that capital available.
Just so everyone understands, unlike your traditional equity managers, private equity funds don't recycle the money. They have to go back out to the market and raise money to have money to put to work going forward, and that's why this cycle works the way it does.
Any questions on that? So as you can see on slide 18, our recommendations is for the system to make a $7.5 billion commitment to Francisco Partners 7 and a $2.5 million commitment to Agility 3. These are the same commitments that we recommended last time. The manager has historically been pretty capacity constrained, so the actual allocations you got were slightly smaller this time, but they continue to increase thoughtfully in fund size. And so we suspect that given the recommendations this time, we fully expect you to be able to get that full allocation unlike last time. But it is the same general approach in terms of sizing for each of these funds.
So last time we requested those, that's the amount that you put in for. You got a little over $6 million to Francisco Partners 6 and $2.02 million to the Agility Fund. So they cut back a little bit. They're anticipated to have one close in February. That's why we were trying to get this on the December agenda, and then we'll be done.
The allocation for this group between small cap and large cap, is that when you look at private equity and venture capital, is the definition of small cap and large cap the same as what it would be for your traditional stocks? Or are they other?
No, we typically, we'll typically view it relative to earnings. And so small cap for private equity will typically be anything less than like 15 million of earnings. Mid cap is kind of 15 to 40 or 50, and large cap would be something above 50. Okay. Is how we typically view that. And somebody
it's
like
all small cap. I mean, this is not.
Yeah, I mean, relative to publics, it's small cap, but within privates, that's typically how we would view it. And Francisco will tactically flex across that range. They tend to be size agnostic. It's really about the management team, the growth rate of the company, the quality of the company, and the end market is how they think about it.
Also, where you had the annualized return or bar graph, I noticed the last 3 years was missing. Is it just not? Is that data just not available?
It's not meaningful. Or what page?
And this is towards the beginning
I think it was page 6.
versus
Yeah.
Publix. And that's where we get into, so
Sorry.
there can be a lot of noise around a one-year number, especially because the valuations, as they're reported for private equity, are lagged. And so we tend not to view it in a 1 to 3 year period. It's typically anything 5, 10, 15 years beyond, because that better matches with the typical duration of a private equity fund is how we view that.
They're just putting money to work in new businesses. And so generally, there's not a return. So vintage 2018, 2019, 2020, it's just so early on, their numbers aren't meaningful.
I see. Is it because they usually have a 3 to 5 year exit strategy for
It's
most of them?
usually, the way you look at it, from the time of a vintage year, 2022 vintage year, that fund is gonna call down capital over years 0 through 5 to invest in companies.
I see.
And then they're gonna harvest those investments in years 4 through 10. So really, you can't, the measurement early on is pretty meaningless.
Because the funds haven't
Oftentimes,
been
it's
invested.
negative because you're paying fees on commitments and there's not a lot of money working yet.
That makes sense. Thank you.
Okay.
All right. So then with that, we can move to the,
Well, maybe we take up, I don't know, can you take up that item first before we move to the real estate?
Well, the item on the agenda is to talk about private equity and the real estate. So let's just go into the real
Okay.
estate,
okay.
both.
And so the real estate piece starts on slide 20, and again, we'll follow a similar format. We'll do a little bit on the market up front and then talk about your portfolio and how the recommendation that we have today fits within the positioning for your portfolio today. But starting with the market environment, again, just on historical returns, if we think about the risk profile of real estate, we'd expect the long-term return to fall somewhere in between stocks and bonds, and that's exactly what core real estate has done. So Odyssey here is the open-end diversified core equity index. That's the core real estate index that we use as a proxy for broader real estate, private real estate specifically. And so that's represented by the dark blue line there. And a couple of things on this chart. One, you can see that expected return profile being between stocks, the green line, and bonds, the gold line, has very much played out over the last 15 years. And the second thing I'd point out is that part of the reason that we like private real estate versus public real estate in the form of REITs is that you get less volatility. So long term, we would certainly expect their return profiles to look generally the same. And I think you can see that here. The light blue line is REITs, the dark blue line is private core real estate, but you have a lot less volatility with that dark blue line, especially during periods of dislocation like in COVID. You can see in early to mid 2020, the severe drawdown that we saw in REITs that we didn't experience with the private equivalent there. And so those are a couple of the highlights that I'd have for you on this chart. On slide 21, just continuing with performance on the left here, it's more of a quarterly return profile broken out by income and appreciation again for the Odyssey, so the index for core real estate funds. And a couple of things here again. So in 2020, the index on a gross basis actually posted about a 1% positive return. If you asked people that in June of that year, I don't think anybody would have expected, especially with everything that was going on with office, retail, et cetera. No one would have expected the index to perform that well. But really what we saw was that things like industrial and multifamily from an appreciation standpoint performed very well, but income was incredibly steady across the property types throughout 2020. So on an annualized basis, we held a very steady at about 4% of that return coming from income, and that helped offset a lot of the value depreciation that we saw in areas temporarily like office and retail. And then certainly, as we fast forward to 2021, income has stayed steady in that 4% annualized range, but we've seen very meaningful appreciation. Continue to see that coming out of areas like industrial and multifamily. But the bleeding has been stopped as well in areas like office and to a lesser extent retail, but especially for very high quality office properties in areas like Manhattan, et cetera. There's still strong demand for that. Now it's a bifurcated market, but there's strong demand there, and we're seeing some increases in rent growth there that's leading to value appreciation. So we actually expect the return for core in 2021 to be about 16%. We won't have the final valuations for another couple of weeks, but that would be one of the strongest years in its history. And so in terms of positioning there, 10% of your portfolio is in that space. We feel good about what we're getting there. And then on the right-hand side, this speaks to non-core. So these are going to be more liquid private equity-like strategies in the value add, the opportunistic space. And here we just show how they've performed. Again, longer term, these are still 10-plus year funds, year strategies. And so how have they performed domestically and globally versus the public equivalents there viewed by REITs? And there's been steady outperformance there. And so we have the 10% target allocation to core and the 5% target allocation to non-core, and we feel good about how that's positioning the portfolio from a return standpoint going forward. And then the only other thing on the market that I would mention on slide 22 is everybody's looking for yield. Certainly real estate can play that role. And again, I mentioned the annualized income return or yield for real estate is about 4%. That's slightly higher than the current earnings yield for the S&P, but importantly, the spread versus the 10-year Treasury is about 260 basis points. That's right in line with the 20-year historical average. And so from a yield and a spread standpoint, real estate continues to play the role. And we don't talk about it here, but there's an inflationary element as well. Obviously, that's top of mind for everyone. A lot of times these leases have natural price escalators in terms of what you can charge based on where inflation or CPI is. And so there's a natural inflation hedge associated with real estate as well that positions the portfolio going forward. Any questions on those slides?
What's the relationship in interest rates? Would it be inverse or?
Yeah, I mean, no, I mean, it wouldn't necessarily be inverse. I mean, they'll typically behave, I mean, anything that yields as rates go up and you're taking some sort of credit risk or some form of other risk, in theory, that would be detrimental. I think the key is what's the rate of inflation, what's the rate of the interest rate increases. And so we don't show it in here. We've actually done an analysis historically of during times of at least modest rate increases, real estate has actually performed relatively well. And I think the Fed this time has done a good job of forecasting that as well. And so people are able to bake it in the prices, bake it into their activity and what the market's expecting, which is important.
Thank you.
So if we transition to the systems portfolio, how it's positioned on slide 23, this is a typical risk return spectrum that we show. Again, you have core in the bottom left. That tends to be very high quality, almost if not fully leased properties. So really the highest quality properties that are owned by those core real estate funds, lower risk, lower return, Morgan Stanley prime properties, the manager that you have in that space. We'll show that in a slide here, but they continue to perform very much in line with expectations, continue to generate strong relative performance versus the Odyssey benchmark. And then as you move out the risk return spectrum to value add strategies and opportunistic strategies, you're taking more risk, but you expect to get compensated for that risk. That risk can come of the form of taking on more leasing activities. So instead of buying a building that's 95, 100% leased, you buy a building that's 60 or 70% leased, and you take on the risk of actually bringing in more tenants to get it to 95% leased so you can sell it to a core buyer. You may take on more leverage risk, more ground-up development risk. There's a lot of tools that these managers, including Angelo Gordon, the recommendation that we have today, there's a lot of tools that these managers can use to balance that risk and generate attractive value with it. And in that non-core space, which would encompass value add and opportunistic, there's three managers in the portfolio today. And maybe if we just jump ahead to slide 24, that's a good segue to performance. I mentioned Morgan Stanley Prime, again, not to belabor the point here. And these are through November, so again, the returns that you're seeing through December are even stronger than what you're seeing here. They've consistently outperformed the Odyssey and actually with less leverage. And a lot of that is driven by, they've historically been at least benchmark weight, if not slightly underweight office, which certainly during COVID has helped quite a bit. And they've actually increased a little bit their allocation to high growth areas like industrial, like multifamily. They also have allocated a little more meaningfully than the Odyssey historically to non-traditional property types, so student housing, medical office, life science labs, media and content buildings, things like that that have pretty favorable supply-demand dynamics, strong macro tailwinds, and so they continue to be very competitively positioned. And then if we look at the non-core performance, it's still a relatively young portfolio. TA in the value add space is really the most mature fund there. It's about 7-8 years old at this point. It's largely liquidated. And again, if we can get about a 12 to 13% return from a value add strategy, really anything from like 10 to 13% from a value add strategy, that's in line with expectations. And then opportunistic, like a Singular Gulf that's going after distressed debt, distressed equity within the real estate market, and Starwood, which is doing something similar to Singular Gulf, but on a more controlled basis globally, and especially with expertise in the hospitality space. If those managers longer term can generate something in excess of that 12, 13% range, that's ultimately what we're hiring them to do. And again, we want to thoughtfully blend those risk return styles. And as we think ahead to Angelo Gordon, they're really a combination of a value add strategy and an opportunistic strategy, depending on the market environment and what they see, particularly in the US. They can flexibly allocate to different types of properties, different risk return profiles. And so from a complementary standpoint, we think they're going to be additive to the portfolio. On slide 25, this again is a very similar cash flow pacing model. Again, 5% target to non-core real estate, so in that value add and opportunistic space. The portfolio today is at about 1%. And so we say that over the next 3 to 4 years to get to that 5% target, if we can commit about $20 million a year, that would be about 2 commitments that the system would make of $10 million each consistently. Then the portfolio would pretty efficiently get to that 5% target. What this doesn't fully account for is that Starwood is very actively calling money now. And so, they made their first 15% call in January. They're going to pretty consistently call about 10%, 15% each quarter going forward. And so it's possible the portfolio would get to target slightly faster than what we're showing here. But again, that's why we always go in at least twice a year, update this so that longer term, 5-6 years out, we can try to hit that 5%, not meaningfully stay underweight, not meaningfully go overweight longer term.
And I'd say, we have this discussion internally quite a bit. I'd say these guys are pretty conservative with reaching that target, because 5% has been our target in opportunistic or non-core real estate for the system for 3 or 4 years now. And it just takes a while to get there. So we want to get there and stay there. What we're doing with this model is being conservative so that we're not saying, okay, well, we want to get there now. So let's put $60 million, make a $60 million commitment this year, and then you're going to put a bunch of money to work the next 2 or 3 years and then potentially be over allocated. So this is a conservative approach to getting to the target in a reasonable period of time without getting too overextended, potentially. If you see public equity sell off and then you still have all this private market commitments, you could get over allocated. So I think this is a conservative approach.
And then on slide 26, that just segues into the pipeline. Again, we have a $10 million recommendation that we plan to make for the system today to Angelo Gordon. I'll touch on the strategy for that fund here in just a second. But again, with only 2 commitments, we would expect Angelo Gordon now and then potentially Blackstone, which is an existing manager for several of our other clients. And they're similar to Starwood in that they're a very flexible, globally oriented, opportunistic manager. If I think about Starwood, they tend to have more of a focus on the hospitality space. They have a strong background in hotels specifically, which during COVID was something that we liked a lot and a partial driver for the recommendation we made to the system a couple of years ago. Blackstone tends to be on those non-traditional property types, life science labs, data centers, things like that. They are experts in that space and have used that to drive very meaningful performance versus peers historically. And so that will be one. We're still doing due diligence on it. They're just launching now, but they're probably going to have a one and done closing in the second quarter. And so pending due diligence, that would potentially be another near-term recommendation for that second and final commitment for this year within the next 2 to 3 months. And then we do expect Starwood, they've been making investments for a couple of years now, even though they just actually started calling capital for that. So we do expect that they would potentially launch later this year. So we have it out here, but we don't expect that we would need to do anything with that until 2023. They're typically open for at least 9 months, and so the thought is that the system could push that to early 2023, but we want to forecast that now as something that's coming within the next 9 to 12 months, potentially. Questions on that? Okay. So then I'll just briefly walk through Angela Gordon. This is just one fund. It's Fund 11, and again, I mentioned it's a blend of value add and opportunistic, and maybe this is a good page to talk to it as any. And so you can see historically they actually split this strategy up into 2 separate fund families. They had their value add funds, they had their opportunistic funds. Both historically have performed in line with peers, if not slightly better than peers. And ultimately what they made the decision to do now with Fund 11 is consolidate those, and like many of their peers, whether it's Starwood or Blackstone, create one flexible pool of capital that can compete up and down the risk-return spectrum. And so Angela Gordon, the team, has been doing this for a long time. Again, returns have been pretty consistent. I think one thing I would highlight is that if you look at the 2007 opportunistic fund and the 2006 value add fund, those obviously put most, if not all, of their capital to work prior to what happened in 2008-9. And so during up markets, frankly, they take a little less risk than peers, and so we wouldn't necessarily expect this to be a top quartile performer. We expect them to perform in line with, if not slightly better than peers in a strong up market. But on a risk-adjusted basis, we're okay making that trade in the context of a diversified portfolio. But in down markets, the strategy across both the value-add side and the opportunistic side have shown a very good ability to preserve capital, as you saw in those 2 funds. And so we like that about the strategy. Again, we like the fact that they've combined them now into one flexible pool of capital that can compete for deals based on truly what they see to be the best opportunities across the spectrum, not just the best value-add opportunities or the best opportunistic opportunities. And this is a broad recommendation that we've made to clients in the past that we're making to clients now, and we think that it complements what you have in the portfolio pretty well.
So
Any
from a
questions?
sizing standpoint, the recommendation to this Angela Gordon Realty Fund is $10 million. Currently, it would be one of 4 managers in your non-core real estate space, really with Starwood and this fund being the more active funds going forward. The Singular Guff and the TA funds are winding down at this point.
Paul, I have one question.
Yes, sir.
On these real estate ones, do you anticipate when they go, they invest in the project and then when they dispose of said project, is there a disposal type fee that they charge us? Or is it back to getting a certain IRR and they get 20% of that, we get the balance of it, or something like that? Could you just kind of elaborate on that?
Yeah, so sometimes is the answer. So with Angela Gordon, no, but with Blackstone, yes. And so it really just depends on who the manager is. Blackstone has consistently been a top quartile performer now for many, many funds over a long period of time, and frankly, they can charge that because investors on a net basis, net of all that, are still comfortable with the relative returns that they're getting. But typically, we don't see that anymore. You used to see that 10, 15 years ago, a little more than now, but typically you don't see it with the exception of someone like Blackstone.
Because what I've been taught on other trusts I've been on or boards, when you're talking about pensions, we don't pay exit fees. You get your preferred rate of return, a percentage of that, and that's it. So I was just wanting to.
Yeah, there are some groups that will have disposition fees. We've seen that in some local groups that we've looked at, and we've pushed back pretty hard on those terms with them, saying that's an issue.
Okay,
for us.
Thank you.
And the only other thing, just because I'd be remiss if I didn't mention it, so the first close for Angela Gordon is in March, and there is a fee discount if you participate in that close. And so the $10 million commitment, if you committed after March, you'd pay 150 basis points during the investment period. You'll only pay 100 basis points, so a 0.5% discount if you commit in March. And so there is a little bit of incentive for getting into that close as well.
Okay. Thank you very much. Great presentation.
All right,
Any
thank you all.
questions? Hearing none, Chair will entertain a motion on item 11D. Have a motion and a second. Please record your vote. Item is approved. And related to that, item number 11E is to approve the private equity allocation of $7.5 million to Francisco Partners 7 and $2.5 million to Francisco Agility 3. I have a motion and a second. Please record your vote. Item is approved. And last but certainly not least, item 11F, approve opportunistic real estate allocation of $10 million to Angelo Gordon Realty Fund. 11. I have a motion and a second. Please record your vote. Item is approved. Item number 12 is investment consultant report.
I'll be brief. We've talked about most of this. You'll see on the December 31 report, the total value of the fund stood at $961.8 million at the end of the calendar year. The asset allocation slightly overweight to equities, in line with fixed income, and underweight real estate, which we've talked about. We've been underweight real estate for some time, and part of these recommendations is to continue to get that opportunistic real estate allocation up a little bit. The core real estate did jump quite a bit. We sent out a revised report that, I don't know if you guys saw the difference, but the Morgan Stanley Prime Property Fund, it was an outstanding quarter. It was up almost 10% for the fourth quarter and a 21% return on the year. So that's bumped up the real asset allocation to about, or the core real estate to 11.3%, slightly overweight. These non-core commitments that we're making, we know it's going to take some time to get those put to work, so we're very comfortable where we are. We don't feel the need to take money down from Morgan Stanley at this time. And as capital calls occur, we'll adjust that if needed. Really, if you look at the second page of the ASAP, the broad asset classes, on an absolute basis, the fund did very well, up almost 11.7%. Gross of fees, 11.2% net of fees. Trailed the policy index a bit, and that changed throughout the year. You'll recall earlier in the year, looking back on a trailing one-year basis, you were about 5 or 6% ahead. Really, it was a pretty challenging second half of the year for active managers in a couple of places, large cap and small cap, really more and fundamentally oriented managers as the markets were up significantly. Within large cap, your second best performing asset class behind private equity, up almost 24.3%. The benchmark was up 28.7. Much like last year, the return of the S&P 500 highly concentrated in a handful of names. The FANG names, once again, Facebook, Apple, Amazon, Netflix, Google, made up 19% of that 28% one-year return, so about 2/3 of the return, so pretty highly concentrated. While your portfolio is primarily passively implemented in large cap, the Intex strategy is what we would call an index risk-controlled strategy. It does weight the names in the index a little bit differently, so it tends to be overweight the smaller cap names in the index that have a little bit more price volatility. That's their approach. And when the mega cap names, a handful of mega cap names are really leading the performance, that strategy is going to trail a bit. So it was up 21.5% on the year. That's really leading to that dispersion within large cap. Your small cap trailed a bit. Pretty huge dispersion between growth and value again. For the last several years, I've been talking about the dispersion with growth outperforming value. This year, within small cap in particular, significant outperformance from value, the more cyclically oriented sectors of the market, with the value benchmark up almost 27% and growth up 5%. Both your growth manager actually outperformed the growth benchmark a little bit. Your value manager, Earnest, more relative value. They don't look real deep value, which we've seen them really doing well leading into 2021. They were up 26.5%, and their custom benchmark up 27. So again, not something that we're hugely concerned about at all. Long short equity, a bit more challenging. This really gets to that fundamental story as lower quality names outperformed throughout 2021. It was pretty tough for long short equity managers focused on fundamentals and also shorting. There wasn't a lot of things going down, and having shorts in your book was a headwind. But we're still following these managers closely. No concerns on individual managers, but certainly much more dispersion relative to the global long-only benchmark, negative when the ACWI is up 19%, but relative to other portfolios of equity-oriented hedge funds, the median return was about 6.3. Have a little bit more direction and a little bit more smaller cap exposure across that portfolio that was a bit of a headwind. Really offset by private equity. Dan talked about the private equity portfolio, but your actual investments did very well. A 34.5% return for private equity last year. I'd go back, if you could go back to that prior, couple pages. No. One more. No. Oh, okay, that's fine. We'll go that. The overall private equity portfolio, which is at about 6.8%, up 34.5%. If you go to the next page, Regina, just in terms of activity, you'll see December was a pretty active month as far as cash flow activity. In the month of December, outflows is when the managers are calling down capital and you're sending new capital to them for fees or investments. You had a little under 1.4 million in capital calls. But you received almost $3.6 million back from managers, so really good month. And then last but not least, the real estate, as I mentioned, up significantly. So overall, portfolio returns very strong on an absolute basis, trailing a little bit on a relative basis. We're not concerned about that. I think we do update our capital market assumptions annually. Probably next month, we'll take a look just to reconfirm the asset allocation, where we are. I don't anticipate us making any recommended changes. We made some pretty substantial changes in the last couple years to your overall asset allocation, increasing private equity from 5 to 10%, increasing real estate, the opportunistic real estate to 5%. We took out commodities. Lowered fixed income a little bit. I don't anticipate major changes, but it's always good to just revisit that. As we've been saying the last several years, our forward-looking assumptions are certainly much more muted than what you've experienced historically. That said, this year, surprisingly, and you'll recall we have intermediate and long-term assumptions, so the intermediate assumptions are anchored more on current valuations and current yields, where long-term, looking out 20, 30 years, is more based on long-term historical averages of broad markets. The intermediate assumptions have bumped up a bit because yields have come up slightly from where we were last year. Still significantly lower than long-term historical averages. The 10-year Treasury this morning is at 1.7. Last year, when we did our capital market assumptions, it was under 1%. So that's a pretty significant change, but relative to long-term historical, it's still fairly low. Equities, in terms of valuations, surprisingly, valuations look a little bit better this year than last year.
because earnings were so strong in 2021. So as you look at the denominator of the price earnings ratio for U.S. and non-U.S. companies, valuations look a little bit better despite seeing markets going up. So that's going to bump up our intermediate returns on equity slightly, but I'd say at 65%, portfolio roughly 65% in equities. The intermediate next 5 to 10 years still looks around about 5.8 to 6.1% type of return, whereas over the 20 to 30 year time horizon, that 7% return does look certainly reasonable. But we'll look at that next month, just to revisit that.
Okay. Any questions for Jason? Hearing none, Chair will entertain a motion to accept the report. I have a motion and a second. Please record your vote. Item is approved. Item number 13 is comments from board staff and citizens.
Chairman, I've got an item that I'd like to be able to discuss with the board. For many of you all know, or for those that don't, the city has begun our transition, or the early stages of the implementation from PeopleSoft to Oracle HCMs for our core people system. Back in June, we discussed briefly with the board, discussing about being able to help with that transition, because Oracle does not align with a traditional pension. Really, no cloud system has an opportunity for the administration portion of our pension. We discussed with the city's IT staff is going to build a gap system right now, but there's really not a lot of technology benefit, and it'll still be very labor intensive for the ERS staff. In discussion with the implementation team, the recommendation and the steering committee yesterday was around doing an RFI, or request for information, to be able to see if there's any systems out there that could work with Oracle that would help improve some of the efficiencies with our pension system. So we wanted to be able to make a motion if the board was the trust was in agreement to be able to do an RFI. It's non-binding, just to see if there is any technology out there that would help the staff.
No, we can't act on it now, but if we put an item on the agenda next month, we can move forward with that.
Perfect. Thank you.
Okay. I would be very remiss if I didn't ask you all to continue to keep Jim Williamson in your prayers.
Yes. I'd agree, and I will tell you, he's watching us. He texted me. So, hello, Jim. We miss you, and we're praying for you. So,
Any other comments?
One more.
Yes.
I would think back in 2008, when we had that funding problem, we got underfunded. At that time, we had decided to put a cap on the retirees' COLA. And since I think we're 111% funded now, maybe it's time to revisit that, because we put a cap on it at 2%. And maybe we can think about raising that up now.
Right, I think we actually put the 2% cap on, I don't think it was that long ago. I think it was 2013 or 14 in there. So yeah, I don't disagree, and obviously I don't want to speak for the whole board. Obviously, you know, the situation with inflation now is not good. I would say that it would probably be prudent to wait and see what inflation looks like over the next year, and if we continue to be in this type of a situation, then I think, you know, that's definitely something we need to look at. So, any other questions,
Yeah,
comments?
Mr. Chairman, I'd just like to make a brief comment that after looking at this report with the county staff, you've done a wonderful job, and it's a very nice looking report. You've done well with that, so good job there. But I'd also like to comment, you know, where we look at these numbers, and it looks so good, 111% funded. And recently, I'd mentioned, I think maybe a couple of months ago, of being out of state at a conference, and how it shocked people that Oklahoma City was funded that high. And, you know, a lot of people would love to have 75% funded. So many of them are maybe down around 30% funded. I think that's a really good reflection on this board, and I'm not talking about myself, but, you know, many of you have been here, and this has been a board that's been existing for a long time. I think it speaks very well of the decisions that's being made and the structure of our administration and the good administration staff that we have. But also, you know, I guess I'm a worrier, but as you look forward, it seems like there's maybe some dark clouds out there when you look at problems that we're surfacing with inflation and unfilled jobs and supply chain shortages, interest rate uncertainty. We've got a pandemic going on right now, and unfortunately a very low approval of our federal government, that there's just a lot of things that are brewing out there. But the comfort that I get going forward with this, I would have to say, is with our investment consultant managers and custodians that, you know, me personally, I have a high level of confidence in everything that I've seen with you, and all these things that look like they may be coming. You know, I do have the confidence in you that you can lead us through this. So I just wanted to make that comment out there for everybody. Thank you, Mr. Chairman.
Thank you. One more time, any additional comments? Hearing none, we are adjourned at 11:11. Thank you, everyone.